What's up, party people? Stocks on the rocks. Who can hear me out there? What's up, Liz? Good evening. Good afternoon, everyone. Happy Thursday it is. Not just any Thursday. Stocks on the rocks Thursday.
It's a thirsty Thursday.
A thirsty Thursday. That's a thing. Whiskey Wednesday, Taco Tuesday, Thirsty Thursday, and F it Friday.
That's right. Amen to that. Amen to that.
Professionally done. I know. We feel like we're a couple of DJs over here.
Mule Monday. It's how we roll, man. It's how we roll.
I'm telling you.
Good to see you, bro.
Good to see you too, man. Hey, we should let them know about we have some stuff going on tonight. Probably let them know that we're not going to go 4 hours tonight like we usually do.
Yeah, 30 minutes. We're doing a 30-minute session tonight. So
yeah, I could probably hang out a few minutes longer, but we thought that the other could probably take the last 20 minutes, 15, 20 minutes, but then turns out we both have things that are keeping us.
We both had the same. We both said to each other, "Hey, I got to leave at a half hour. Are you going to be okay to take the rest?"
So it's cool. We get a lot packed in like a half hour, 40 minutes, but just talk fast. Don't waste any time. That's exactly right, Liz. That's exactly
100%.
right. So if you're interested in turning your cameras or microphones on, this is a chance to ask questions, get into conversations. It can be about anything. It can be about nothing. This is just about hanging out. And if you have a cocktail, have a cocktail. If you don't, that's all right too. But this is open Q&A, office hours, happy hour. So we come generally prepared with nothing to talk about specifically, but you know, we always have something in our back pocket just in case.
Just in case.
Just in case. What's up?
We got a great first question. Why don't you stop share so our faces are a normal size?
I will. Normal size faces.
Normal size faces. So we have a great first question. How do you decide when a stock is bullish or bearish? So I guess that question then becomes, is it currently bullish or bearish, or is your outlook bullish or bearish? There's Liz.
What's up, Liz?
Hello.
Both. Okay. So for me, the determination on bullish or bearish is based upon trend. Always based upon trend. What is the trend of my big picture direction? So if I am trading and when I look at trend, I'm looking at a consecutive series of higher swing highs, higher swing lows for uptrends, lower swing highs, lower swing lows for downtrends. And I need to have those things in there together. If I don't get them, if I don't get the two consecutive higher lows and two consecutive higher highs, then it's kind of a sideways trend. That's kind of the way that I look at it. So
Yeah.
to determine current state, I look at the trend on the big picture.
Yeah, and big picture for a swing trader for you, Chuck, would be the weekly chart. Is that right? Or are you talking about the daily chart, which is your trading time frame?
Yeah, so I like the daily chart, which is my trading time frame in that case.
Okay. I'm going to share a screen really quick. I'm going to bring up Trading View, and I'll kind of support what Chuck was just talking about. You should be able to see it. So there are several periods. This is Alcoa, just the chart that I had up. There are several trends in here that I think are really great to point out, right? If you go back to this window of time right here, what Chuck was talking about was a series of lower lows, right? Lower highs, lower lows, lower highs. And you can couple that with the fact that these are very popular. We use them because millions and millions of people use them. The 20 period moving average in blue crosses below the 50 or the longer period moving average in red and then resumes its lower highs, lower lows. That is a bearish trend. Now, at some point, that trend is going to end. And you can see where prices tend to stabilize and go somewhat sideways and then start to make higher lows, higher highs. And we get that crossover where the 20 is back above the 50. And here's that series of higher lows, higher highs that Chuck was talking about. How bullish or bearish are you, meaning mildly or aggressively, would depend upon how much higher each high is getting. And so this is more of a mild bullish trend. This is more of an aggressive bullish trend. And then to Chuck's point, This becomes more sideways where highs and lows are about equal, and those moving averages become useless because they're just sideways price action. So hope that supports what Chuck was saying from a visual standpoint looking at the chart. Bennett, you got any questions on that before I...
Yeah, and when I look at that, what I'm really looking at is from an outlook or from the current standpoint, like are we -3, which would be very bearish, -2 is bearish, -1 is mildly bearish, 0 is neutral, +1 is mildly bullish, +2 is bullish, and +3 is aggressively bullish, right? So if I were looking at this period, clearly that's going to be a +3 price action. This is going to be a +2 price action, right? And there's a +2, and then this would be a +1. And really, that's the slope of our trend, is the way to think about it. What I would look at now is I would say, all right, well, the slope of my trend is basically sideways. And so to me, as it stands right now, we're at a 0 on this particular stock.
That's right. And if I were Liz, I would be writing iron condors all over this.
Right.
And that's condors.
A joke. Please be my guest. Put on as many iron condors as you can, because I want this market to finally do something.
There's our wings.
It's just
no faster way to get a market to break out or down than to write an iron condor on something that's been sideways forever.
So great. Does 5% or 10% change apply? Well, Bennett, the problem with putting a percentage on it is that percentages are relative to that individual stock, right? And so I don't have a set percentage. Like I will tell you, I've done a lot of work in the past for Investors Business Daily. I did a lot of stuff with IBD. They asked me to kind of help write an options course a couple of years ago. And they have a strict rule, 8% as their stop loss. Like that's their strict rule, 8%. On an 8% pullback, you're out. Well, my problem with that 8% rule is some stocks, 8% is way too much. Some stocks, 8% may not be enough. And so I don't have an actual percentage on that, Bennett. I want to look at the most recent swing highs and swing lows for the current trend. Now, the next piece of that is how do we assess the soon to be coming trend, right? How do we assess bullish or bearish as an outlook? So here is where we start to look at things like momentum changes and approaching levels of high quality demand and supply. And so if you have a stock that let's say is a +3, and it's been a +3 for a long time, but we start to see that the momentum is slowing down on that stock, then we may start to see that our +3 can very quickly go right to 0. And that's exactly what happened in Alcoa, is it went from +3 to 0. And so from a +3 to 0 is basically not even a slowing of momentum, it's a stopping of momentum, right? There is no momentum left in there at all. So now what's the next most positive outlook, most positive outcome? Basically, I believe that strength begets more strength, weakness begets more weakness, and when we're in a neutral, I don't want to do anything. And so for example, if we've gone from a +3 to a +1 to a 0, now I think we're ready to roll over to a -2 or a -3 even. But if we've gone from a +3 to a 0, I don't know what we're going to do there. So I kind of want to see what was the price action going into current state before I assess future state.
I will also couple that with so like a case like Alcoa. Let me share the chart again before I go to this other chart. A case like Alcoa, which I think is great. I would agree with you, Chuck. If you look at Alcoa, it is a materials stock, basic materials, and XLB itself has pulled back actually pretty sharply. It was consolidating and it pulled back. And it looks like it still wants to pull back now that it's below its 20-period moving average. So when Alcoa is sitting up here near the top of the range...
Corey, can you share just that part?
Oh, did I not share?
Yeah, you're sharing your whole screen, so.
Oh, yeah, that's gonna mess people up big time. Because I've got a big screen, dog. What about that?
Yep, that's better.
Oh, thank goodness. All right. So with Alcoa, it has not really pulled back the way that the entire sector has. So this is a range where I could very easily see what Chuck is talking about. If the whole sector rolls over, I could see this rolling into potentially a -1, -2, -3. If we get a lot of basing in this area and we just kind of park ourselves right up at the top of this range, this then becomes something like this, where I would almost, if the basing is nice and tight and not a wide range, I would expect this high base pattern to actually break out. And we saw that a lot in silver, in gold. We saw that in Honeywell. I mean, just this little bit of basing followed by a breakout. When we start getting into wide ranges, that's when I think, Chuck, you're right in saying that we got these wide, just sideways, big range bound, not high base. This is the point at which, I think that if momentum is very negative like this, we are going to start to see that roll into -1, -2, -3 pretty quick.
So, Bennett, great question. Does the sequence of red and green candles give an indication of future moving from a sideways trend? I don't know that it's the sequence of red and green candles per se, Bennett. What I do look at are wicks. If I see a whole bunch of upper wicks together, that to me typically shows a fair amount of potential bearish activity. If I see a whole bunch of lower lower wicks, then I typically see that there's going to be some bullish activity. Those are ones that I really, really care about. Is what direction is it telling me at that point from a standpoint of bullish and bearish activity? I'll use the wicks. I don't really care about the colors of the candlesticks. To me, are some of the least important concepts. I care about what are the wicks, because the wicks to me are what tell the story, because it's the closing price relative to the high or the low of the day. I could look at the candles and they could be black and white and they could be all blue. It doesn't matter to me, but the wicks matter. So a good example of that is Marvell. Pull up MRVL. Which, remember yesterday I said, Corey, that if we don't put the trade on, I guarantee you what's going to happen tomorrow.
Yep.
That's what happened. So look at Marvell, and Marvell rallied straight up. And yesterday, Corey and I were talking about this particular one, and what I really liked were those two upper wicks, right? Those two upper wicks, meaning where we saw tweezer tops. Now, if you look to the left, we had tweezer tops in the past at the same spot. And so two tweezer tops in the same spot tells me that's huge price rejection. That is a trend changer. And so I'll look for signals of prior trend change and prior price rejection. If you look up or over at that really big high in the beginning of December, you notice the same thing, those high upper wicks. So wicks tell the story when we're looking at candlesticks, and I'll use the wick much more so than the color of the candle.
Yeah, I would agree with that. Wicks are whispering to us what's really going on. Now, I do want to point out where, and I pointed this out in the trading room the other day, the Qs, which have been, relatively weak in terms of an index, like this is the NASDAQ ETF, compared to Russell, Dow, S&P, the Qs have been relatively weak for a lot longer. But the thing that struck me, and this is really all bodies, I mean, you do have these long lower wicks, a couple lower wicks coming down here into demand. But the thing that I still do pay attention to bodies, because if you look closely, take for instance here, every time price closed on this candle, gap down here, and then closed green. Gapped up, closed green. Cap down, closed green. Gap down, close green. Gap down, close red. There's one day. Close green. So there's a lot of gap down, close green. Gap down, close green. Gap down, close green. This to me tells me there's a lot of very bullish pressure. And I do agree that we do have some long lower wicks down here. But the fact that we're gapping down and getting a lot of green candles, certainly the number of green candles in the last month largely outweigh the number of red candles. this to me tells me that we're starting to potentially see a shift from relative weakness in the NASDAQ to potentially relative strength. I'm not ready to call this, any sort of, oh, the NASDAQ's about to break out and make new highs. Not at all. I'm just finding it a little suspicious that we're holding up around this area of support a lot, and we're getting a lot of green bodies. So I wouldn't say ignore the bodies, but the wicks tell a very quiet story, and the bodies are yelling very loudly, where the wicks are telling a very quiet story. And the trick to I think trading and anticipating moves is to listen to the whispers, per Chuck's advice, on how wicks can tell a very, very clear story.
Yeah, the wicks tell the story. I did a video on that recently. I think it was a YouTube short or a small short educational session on it. But I think that I love looking at wicks. Wicks to me tell a whole lot about what's going on. And by the way, that's because I used to lean on stochastics, and stochastics essentially measure the average closing price from the average high and the average low. That's why people always used to call stochastics leading indicators. When I first started trading, people said that a stochastic is a leading indicator. No, it's not. It's just measuring wicks. When you have a lot of upper wicks, then you're going to have stochastics that begin to roll over before price goes down. Yeah. So, hey, Liz has a great one in here. I've collected some generous lunch money on bear puts, but the risk seems to be so high relative to the potential reward. And you're trading off daily charts, and so when you're looking at those, does it make sense to be looking at bearish trades? I actually agree, Liz, that the market, we're resilient. The dang market is very resilient, and as much as there's a lot of stuff going on in the world, we are seeing everything is telling us from a sector rotation side, from the fact that our slowed momentum on the way up, every technical signal that I know of says we should probably roll over. But the fact is, we haven't. And so we've got to trade the chart that's in front of us. I do like the idea of short-term shorts to the downside for lunch money, but we still are entering into regular long positions in the market. Corey and I took a number of short puts in the fund this week because we believe that there are values a little bit lower than where current price happens to be. That being said, we did also take some bear call spreads for things that we think are probably not going to go above a certain level. So right now, at least for us, the portfolio is kind of balanced with a little bit of negative delta in order to profit if the market goes down and also keep it from going up too high. But also, because we're getting some fairly juicy premium far away from current price in some decent issues, it makes sense to be selling puts at lower price points where we're getting decent premium, knowing that if it goes down into there, they're not stocks that we think are going to go out of business, even if the market drops.
Right. Yeah. I mean, if I could... go ahead, Liz.
No, so I was going to say, so my challenge has been more on the long-term wealth things where I've owned for a very long time and got some very significant profits. I've wanted to try to do some bearish trades just to collect some additional profits while the market goes down before it finally turns and goes back to the upside again. I'm less concerned about things that I don't really care if I do or don't own. I mean, I've been doing covered calls against those, and that's collected something. But it's
you can do covered calls while those things are pulling back if you want to stay in the position.
Right, but I don't want to do a covered call on something I really don't want to sell. I mean, I've got a big tax issue if I get called away on some things that I really don't want to get called away on.
Well, the other thing you could do on those, Liz, is you could hedge. You just hedge with a straight put and delta hedge, right? So.
Right, and that's what I've been doing. But I mean, back to Corey's point a short while ago about gap down, end with a green candle, gap down, end with a green candle. It's not like the market's really cratering. It's just overall heading down.
Yeah.
So unless you enter your bearish trade close to where your stop would be, the risk you're putting on for that trade is pretty significant. Or would you take the view that if you're hedging against long-term positive delta, would you just therefore buy a put and have no stop? Like, how would you do it? Because I've been trying to do some bear puts, with a stop.
So my quick recap on that, and we did this a bunch in the fund where we were a bunch of positive delta selling puts, long call spreads, some long stock, and we get into this period of time where it's like, oh, we're a little bit too positive delta. Let's buy some SPY puts. Just, a little bit deeper out of the money, SPY puts for catastrophic protection. Let's say that we did that 15 times. 14 times out of 15, we wasted our money doing that.
Right. That's the thing.
It's just sort of
So
like, because the whole market is strong, just buying puts on in a strong market is terrible. Now, what I've switched my way of thinking, personally speaking, is I used to do this a long time ago, and I got away from it because the market has been so bullish, and you guys have seen this who are in the trading rooms. It's like, I don't necessarily need to be hedging using the S&P. I can have some negative delta positions in weak sectors, right? So now I'm looking at shorting specific stocks in weak sectors to have negative delta in those weak sectors. So if the market goes up, we're long energy, but you're short financials, and that tends to pay off better than just buying S&P puts in a bull market. Do you know what I mean?
And that sounds fantastic, but then you start looking at some of the spreads and you think, no.
Yeah. And that's become an issue across the board with options, right? Like I have this entire sector ETFs. Like if I'm going and I'm looking at financials, there's 40 stocks, 50 stocks in the S&P, and 90% of them suck as far as spreads and liquidity. So what I've started doing is I've actually started to take my basic fundamental screener of stocks between $10 and $1,000 that have 20,000 minimum open interest, and I'm still playing with this number, that have volume greater than 1 million and don't have earnings coming up, and just intersect that with the XLF, which is the financial stocks in the S&P, and it gives me like 9 stocks to look at, not 40. Do you know what I mean? So I know with the somewhat high degree of probability, these stocks, the AIGs, the American Express, the Bank of America, Cities, Fifth Third, Wells Fargo, these guys, State Street, are more than likely going to have better liquidity than just kind of like CBOE has shit spreads, right? Forget it. Yeah, I mean, it's terrible, right? I mean, it's in the financial sector, but you could short the Goldman Sachs has terrible spreads, right? They're in the financial sector.
Which is such a shame because spreads were not this issue a year ago.
No, it's like we're being discouraged from trading options.
Well, you know what it is? It's they've lost so much liquidity to zero DTE options that they've got to make up the money that they've lost by people moving to zero DTE options in these other in widening the spread of these single issues.
Yeah, maybe. I mean, why would they need to make it up? They're getting all their money on zero DTE. Why do they need to make up anything?
But there's almost no spread in the there's no spread in the zero DTE options. So they're not getting the spread in the zero DTEs, and so you're widening out the spreads everywhere else.
But they're getting volume. So you either have volume or you have spread width as a market maker, as a dealer, right? So, what is zero DTE? 0 days until expiration. So like if you look at SPX, for instance, and you look at their options, they have 0, 1 day, and there's always like 1 day, or these options expire today, 0 DTE. These options expire tomorrow. These options expire, you know what I mean? So 0 DTE is 0 days to expiration. We're not talking long term, 1 week, 2 day, 5 day. 0 days. They expire today. And on the indexes and some index ETFs, they have 0 DTE options, which have a ton of liquidity, just a ton.
But
right?
It's also not just the indices. I mean, recently some of the Mag 7 have introduced.
Oh yeah.
The more 0 DTE options trading you have, the wider the spreads are going to be in those that don't have 0 DTE.
I blame Amazon's same-day delivery for this nonsense.
Yes. We all
That
want
we're in the
instantaneous. It
we're in
started
the
with
age
1 hour photo.
This is the age of immediacy. And if you can't get it now, I want nothing to do with it. When my kid orders something off of Amazon, he says, when's it gonna be here? I'm like, dude,
So,
you just ordered it like 20 minutes ago.
so I was looking, I just looked, I used all of my powers of research, aka Grok. And SPX, right? SPX, which is the most liquid options vehicle on the planet. 59% of SPX volume is 0 DTE options.
Wow.
That means every day that options are traded, the ones that are traded the most, it represents 59%. And look at this, 0 DTE options represent 24% of all US options volume. And so when I literally just asked Grok, why have the option spreads gotten so wide this past year? The first thing says explosion of 0 DTE amplifies visible spread behavior. Not that AI is always right, but it can search a heck of a lot of things faster than I can. But that is really, and when we spoke to Lex from Tradier, and Tradier, if you guys don't know, pretty good brokerage. Lex Lutheringhausen is wicked smart. When it comes to options, he said the exact same thing. He said these 0 DTE options are causing a lot of angst in the industry because the specialists aren't making their money off the other positions, and then the 0 DTEs are being used to hedge gamma, and because they're being used to hedge gamma, they've widened out the spread everywhere else to protect their risk.
Damn it.
So, how much can you make on DTE greater than $100? Are you asking how much can you make on 0 DTE? Bennett, I mean, you can make an unlimited amount of money in anything you trade, depending on the amount of risk you're willing to take and what you're going to do. So I think when you're hedging large, long-term gains that you don't want to realize for tax purposes, my belief is either bear puts, either straight puts. I think straight puts that's what they're designed for, right? Literally, that is what they were created to be, is insurance policies against long stock. So
with no stop then, presumably.
With no stop. Nope.
Right.
I mean, nobody at the end of the year goes, dang it, I didn't even use my homeowner's insurance this year.
I do. That's stupid policy.
Yeah, I mean, it does make the most sense, because otherwise, if you're just doing a barefoot spread,
well, and the other side you got to remember is if you just go the straight put route, let's say you just go the straight put route, yes, you're theta negative, but you're also vega positive, and if it does crater, you're going to get the delta and you're going to get the vega.
Yes, agree, and I guess your risk is capped at what you paid in the first place.
Yeah. I mean,
that's where I kind of like
think of it as just insurance. Like, for example, I am not opposed. I was talking to somebody the other day about the SPY. You could go out and buy like a 6-month SPY at the money put. And it's actually even better if you go like 2 strikes in the money. The SPY 2 strike in the money put, it's like 3%. So am I willing to put up 3% of my capital? No, that's the SPY. Individual stocks are going to be more expensive, but I mean, I could buy 6 months of the SPY for 3%, and now I'm completely hedged.
3% of what? 3% of what, Chuck?
3% of the cost of the SPY, I think, is what it was when I looked at it.
I would probably always vote buy a little bit out of the money so you get the gamma bump.
Good point. So I went a little bit in the money.
Cheaper.
I went a little bit in the money, so you're paying less for the extrinsic value.
I would personally go out of the money so you get the gamma exposure and the quick acceleration and high vega exposure out of the money.
But I'm going with on the assumption it doesn't move.
Oh,
spending
true.
Less, right?
True.
So if
spending less on extrinsic
you're getting
value.
it as pure insurance, I want to pay less extrinsic. If you're going a little bit out of the money, then you are speculating that it is going to drop, and you want that insurance. And like you're more aggressively thinking it's going to drop if you're going a little bit out of the money. If you go a little bit in the money, you're going a little bit more conservative. But you're more likely to lose the money.
Well, so if the market right now is at, the devil's going to love this, 66606.
Oh no.
on SPY.
Oh,
The 650s have a $30 extrinsic value. The 680s have a $30 extrinsic value, so it's the same extrinsic value, but the out of the money option costs $10 less, but we have the same extrinsic value exposure. So it depends upon how much Vega exposure
right.
and intrinsic value you want. And there's no wrong answer. I prefer the gamma bump. We pay the same amount of extrinsic value, but you get a higher delta out of the gate. I will get a higher gamma bump if
I'll tell you
if
what,
I'm right. So
this open office hours just turned into like a master's class on options Greeks.
dude, this
So,
is crazy. I
hey,
love this.
I've got to run and go pick up my son
Such
from
a
baseball.
nerd.
I love
Such
you all.
a nerd.
Hey, join me in my class on Sunday night. Peace out, Cub Scouts.
True. I'm not far behind you. I got about 10 more minutes, and then I've got my appointment that I have to make. So this is fun. Last question for a beginner. Do you always trade when the market is open, or do you ever want to enter trades the night before? That's a great question. So I just had a mentor session, just one-on-one, and we set up some trades, and it was like 2 o'clock in the afternoon Pacific time, so the market's been closed for an hour, and I placed the trade to show the process of setting up the entry with the stop and the target, and I placed it, and it was working in the account. Obviously it won't fill because the market's closed and it's options, but it would fill tomorrow if I get the right pricing. And I also said, however, this particular trade, if the stock opens where it closed today, if it opens tomorrow where it closed today, then the pricing is probably going to be roughly the same. I wouldn't mind just leaving it out there. However, in the event that the stock moves sharply in the morning, I may not want that trade anymore in the morning. And so personally, nowadays, I have the luxury of being at my computer in my studio before the market opens. I can analyze the position that I looked at last night, and I can decide in the morning, as soon as the market opens, do I want this order to work or not? There was a time where I was working and traveling and trading at the same time, and I couldn't always be in front of the market at the time the market opened to view that. So I had no other option than just place it the night before and hope for the best the next morning. The best bet is to always be in front of the computer at the time of entry. That's my philosophy. I always want to be present at the time of entry, but when it comes to stops and targets, I'll place those and let those work. But I know not everybody has that luxury. But, for the most part, I'd say probably 7-8 times out of 10, you would probably be fine placing the trade the night before, getting filled in the morning. 7-8 times out of 10, you're probably going to be fine. There's a couple scenarios that I've had in the past where the market just gaps horrendously. And I'm like, oh, shoot, I don't want that anymore. Now I'm already in it. Or I got in it, and then as soon as I got in it, I got back out of it because my entry price was below my stop, and as soon as I entered, the stop was hit, and I just round trip got in and out. And I didn't lose any money, but just a little bit of a waste of commission there. So I tend to plan trades. When I used to trade, when I wasn't in front of the computer all the time, I'd plan trades the night before, place them, just kind of double check them, look them in the mornings. Nowadays, I don't even plan personally. I don't even plan trades after hours. I just, when the market opens, I see how things are moving. I go into my scanning at 6:30, 6:45 in the morning Pacific time. Market just opened 15 minutes ago. I'll scan. I'll usually get through that process at around 7:15, 7:30. I'm done with that. And by 7:45, 8 o'clock, I'm pretty ready to execute what I found. And if I didn't find anything, I'm not going to force it. But I have the luxury of being able to be in front of the screen at the market open. Not everybody has that. So, like I said, in the past, I would do everything at night, double check it at the open, or leave the order working. And 8, 9 times, 7, 8, 9 times out of 10, I'd be fine. But there were a couple times I was like, ugh, that was a terrible entry, horrible fill, wide spreads. I really wish I was in front of the market at that time. I wouldn't have traded that, but nothing that's like, end of the world, problems. And everybody's got a different schedule, so you have to kind of build your process based upon your availability and schedule and all that kind of stuff. So those are my takes on that. And I've been through both scenarios. Nowadays, I do have the luxury and curse of never leaving this seat from 6:15 in the morning to in some days it's only 1:30 in the afternoon Pacific time. Nowadays, right now it's 5:30. I haven't left this seat except to go shower and grab some food. I haven't left this seat since, 10 hours ago. So my hips hurt. But some days are very busy. Some days are a lot lighter. But my luxury item is I never leave my house. My studio's in my house. So I never leave during market hours. So I have that ability to just be in front of a computer at a moment's notice. Even if I'm, out, getting some sun or putting my feet in the grass or getting lunch or grabbing coffee or, talking to the family or, even if I'm playing drums for 30 minutes, if I get an alert and I need to stop, I can be in front of my computer in 10 seconds, right? And I know not everybody has that luxury, so you just kind of have to build a system that works for your schedule. And yeah, it's not healthy. I agree with that, Liz. Definitely my hips hurt after sitting here for a little while, and I need to stretch and work out and go on walks and all that kind of fun stuff. But self-inflicted.
Quick question. How do you hear your alerts above your drums?
I can see it on my phone, and I can see it on the computer.
Uh-oh.
And it also depends upon what I'm playing drums to. So if I'm tracking drums for a song that I'm recording drums to for a studio session, I would just have to see it on my phone, which is always over on my side table by my keyboard. If I'm just playing along with like cover songs and I'm just playing to play music that other artists have done that I really like, then if I'm usually just playing like headphones through my phone, and as soon as an alert happens, I'll notice it and I'll be like, oh, gotta stop playing, something's important come up, and then I'll just hop off and come do this. But I got alerts coming from every direction, Liz. If I'm tracking drums, alerts are all off. But I don't track drums for that reason during market hours. Tracking meaning recording drums for professional purposes. If I'm recording, don't text me. Like, all my alerts are off. I don't need a bang showing up on my recording for a commercial release. I don't need Discovery Channel going, what's that noise? Oh, that's just a text message from Thinkorswim. Don't mind that. So, order filled. That's right, the old trade station. Order filled. We have at the fund. I'll say this, and then we'll wrap up in a couple minutes here. We have interactive brokers for the fund, and the fun thing about interactive brokers is you can set your own audio alerts for things that happen in the market. So we very much value Samuel L. Jackson's voice, and we have Sam Jackson that tells us how great we're doing and how terrible we're doing at certain things, and how if your order's filled, it'll tell you, and he's super excited about telling you. So you can set your alerts to be something other than the default, because
you can in TradeStation as well. I've never done it, but I'm pretty sure you can.
Oh yeah. The default guy at Interactive Brokers, who the fund is through, is like, order filled. I want to punch that guy in the face every time I hear his voice. So I had to change that to something more that I like to hear. So we've messed around with some South Park stuff and Samuel Jackson stuff. We like to have fun when we trade too. Can't all be serious. But yeah, you don't want order filled in the middle of tracking drums for a commercial release. So awesome. Well, this is fun. You know, normally we spend about 45 minutes to an hour, right about that 40-minute mark. Chuck had to bail to run pick up his kiddo. I've got to run to do something similar. Got a performance tonight I'm going to go watch. My kids are performing, so I'm going to go do that. And so, you know, normal hours, we do an hour, but we got 40 minutes in tonight. Great questions, great commentary. So appreciate you guys showing up and hanging out. So, and yeah, great, Bennett, great questions. Liz, great commentary. Appreciate you guys very much. And so I will see you guys on Monday in the trading room for those of you who are Traders Army members. If you are not a Traders Army member, you can always go to TradersArmy.com and use the promo code, if you're new to Traders Army, Trader60, Trader60, get 60% off your first month's membership. Check us out, hang out with us. We have 8 trading rooms a week, and lots of fun between Chuck, myself, and Herman throughout the week on stocks, options, futures, crypto. And yeah, we do a lot of stuff, community like this. So check it out. Andrew, new here. Yeah, Trader60 if you want to check us out on a more regular basis. You know, check it out, and we'd love to have you as a member, and you know, just kind of hang out and see if we're a good fit for you. But yeah, it's a lot of fun. Appreciate you showing up tonight, you guys, and I will see you guys on Monday in the trading room. Those of you who are members, you have Herman tomorrow morning for your futures trading room. What's up, John? I see you there. So yeah, let us know if you need anything. We're here for you guys. If I don't talk to you before then, have a great weekend. Peace out.